Welcome back to TalkTickers, the show where we break down those earnings calls so you don't have to.
That's right.
And today we're diving deep into Rollins Inc's Q3 2024 report. And this one, I got to say, this one's got a few twists and turns.
Yeah, a few head scratchers for sure.
Rollins, for those of you who may not know, is the company behind all those pest control brands we see everywhere.
You know them, those Orkin trucks and the Home Team Pest Defense?
Exactly. But here's the thing. They met their revenue expectations this quarter, but the stock actually took a pretty big hit.
Yeah, it did, like a 6.57% drop on the day of the call. Ouch.
Yeah, ouch is right. So what gives? I mean, that's what we're here to figure out.
Well, you know what's interesting here? On the surface, the numbers actually don't look bad at all.
Really?
Yeah, revenue jumped 9% year over year. They landed at $916 million. And organic growth, which is a really important metric, clocked in at a very respectable 7.7%. You'd think Wall Street would be pretty happy with that.
Yeah, I mean, it's not every day you see a company growing at that kind of pace. So what's the disconnect then? What's spooking those investors?
Well, I think first we've got to remember the timing of this earnings call. It was October 24th.
Okay, so what about October 24th?
Well, that was right after Hurricane Helene slammed into Florida. And remember, Rollins has a huge presence, particularly in the Southeast, so that storm definitely left a mark.
Hurricane Helene, I remember that. I mean, those news reports were pretty rough. Did Rollins actually quantify how big of an impact that hurricane had? It couldn't have been just a minor blip, right?
Oh, they did. CFO Ken Krause estimated that Helene actually shaved about $2 million off their revenue growth.
Wow.
Yeah. So think about it. Without that hurricane, their organic growth would have been even higher. But here's the kicker. Despite that hit from Helene, and there was actually another hurricane right on its heels, Rollins is sticking to their full-year outlook.
Really?
Yeah. I mean, talk about confidence, right?
All right, so they're taking a we got this stance. Interesting. Especially considering two hurricanes back-to-back like that. But let's be honest here. Hurricanes are unpredictable. What really has those investors, buzzing is Rollins' growth strategy, and specifically, all that money they're spending on it.
Yeah, some analysts are even calling it a spending spree.
Yeah, and not everyone thinks it's a wise move.
Exactly. And I think that's where we start to see some potential cracks in the, in the facade. Rollins is investing very heavily in growth, particularly in sales, staffing, and marketing, with a big emphasis on that commercial pest control sector. And that's driving up their SG&A costs, those sales, general, and administrative expenses.
Right.
And that, of course, puts pressure on their margins.
Okay, now that's starting to make sense. So investors are worried about whether this level of spending is sustainable, especially with inflation cooling down. Like, is Rollins playing with fire here?
Precisely. And during the Q&A, analysts were really grilling Krause about this. Is Rollins chasing growth that might not be there? Are they overspending to the point where it could actually backfire?
So how did the company respond to all these concerns? Are they acknowledging the risks, or are they just doubling down on their strategy?
Well, Krause's response was pretty interesting. He emphasized that Rollins sees these as necessary investments in a growing market, and they're confident these moves will pay off in the long run. They're really playing that long game, banking on the idea that increased revenue will eventually outpace these higher costs. And that, will lead to better margins down the line.
It's a bit of a trust us, we know what we're doing kind of argument, isn't it? But investors are a skeptical bunch, You want to see results. So what's the evidence looking like?
Well, their gross margins did tick up slightly to 54% for the quarter. That's a 20 basis point increase year over year.
Okay, that's good. Right.
Yeah, it's a point in their favor. It shows they're managing to balance those price increases with the rising costs, at least for now.
Okay, but didn't you say their operating margins took a hit? So what's the story there?
Right, that's where those hefty growth investments we were talking about really start to show their impact. Their quarterly operating margins came in at 20.9%, a 20 basis point decrease year over year.
So even though their operations are getting more efficient, the gains are getting eaten up by all that extra spending? I guess that makes sense. But what about their overall profitability? Is that still moving in the right direction?
That's where we have to look at adjusted EBITDA. For those who might not be familiar, it's a measure of a company's operating profitability that excludes certain non-operating expenses. It gives a clearer picture.
Okay.
And Rollins' adjusted EBITDA was $219 million for the quarter.
All right.
That's up over 5% year over year.
Okay, so profitability is still going up?
Yes, but here's the catch. The margin actually contracted by 80 basis points to 24%.
So profitability is growing, just not as fast as revenue.
Right. Not exactly the ideal scenario for those investors looking for that explosive growth.
Yeah, it's definitely a bit of a yellow flag. But Rollins is maintaining that this is all a calculated trade-off, right?
Exactly. They're betting that all these investments will eventually lead to even stronger profitability. The big question is, will it pay off?
Yeah, that is the million-dollar question, isn't it? It seems like investors aren't totally convinced. I mean, hence that stock drop we talked about. So what can Rollins do to reassure those investors? What are those key factors that will determine their success or, failure with this whole ambitious growth strategy?
Well, there are a few crucial things to look at. First, their ability to keep raising prices, even as inflation cools down, is going to be critical. And then there's that whole question of their commercial pest control strategy.
Yeah.
Can they really disrupt that market and achieve that growth they're projecting? That's the real question. So before the break, we were talking about Rollins' big plans for growth and those red flags with their margins. Investors are definitely nervous. So let's dive into what'll make or break this gamble, shall we?
Yeah, let's get specific. First up, pricing power. Can Rollins really keep raising prices even as inflation cools down? Won't people start pushing back?
That's the question, isn't it? And the analysts were all over this during the call, especially with 2025 right around the corner.
Right.
But both Gallhoff and Krauss, they were pretty confident, actually.
Oh.
They were pointing to how essential pest control is. Like, people aren't going to let their homes get infested just to save a few bucks.
That's true.
And they emphasize they're keeping an eye on those CPI trends. The Consumer Price Index, they'll adjust pricing accordingly.
So it's kind of a trust us situation.
Yeah.
But I'm curious, is there any proof that pest control really is, inflation proof? Have they raised prices before without losing customers?
That's a good question. And honestly, the call didn't give us specifics on that, like past price increases and how it affected customer retention. We'd have to dig into their older financials for that.
Okay, fair enough. Something to look into, for sure. But for now, let's say they can keep raising prices some. Those big growth investments are still worrying, right? Can Rollins make enough revenue to back up this spending spree?
Exactly. And that brings us to their commercial strategy. That seems to be the core of their whole plan.
Right.
Rollins is going all in on commercial pest control. And it kind of makes sense. They see it as this multi-billion-dollar market with great margins.
Yeah, and I guess businesses aren't as picky about prices like homeowners.
Right, exactly. And they're way more likely to sign those long-term contracts, the really profitable ones.
Plus, the contracts themselves are probably bigger for commercial clients. Treating an office building's got to cost way more than a house.
Exactly. But is Rollins actually doing anything different in the commercial space? Like, what makes them think they can beat the competition?
Yeah, what's their edge?
Well, Gallhoff kept saying they're just getting started with their commercial strategy. He even hinted they might make a second commercial division later on, which is a bold move. He talked a lot about stickier customers, too, those commercial ones that stick around for a long time.
So they're going for those long-term relationships with the big clients. Makes sense. But it still feels a bit vague. What's their secret sauce here? Any specific niche they're targeting or using some new technology to stand out?
Sadly, they were pretty hush-hush on the details. Probably don't want to give away their secrets to the competition, right?
Yeah, right.
But they've done a lot of successful acquisitions before, so maybe they're planning to buy up some other companies to grow quickly in commercial.
Good point. Rollins does have a good track record with those acquisitions, merging everything smoothly. But acquisitions can be risky, and they take a lot of money. And speaking of money, can Rollins actually afford this whole plan?
Yeah, the elephant in the room, right?
They're spending like crazy, and their margins are feeling it.
And this is where it gets interesting. Despite all those spending worries, Rollins is in great financial shape. Their cash flow is super healthy. It was up 16% year over year, reached $139 million this quarter. And their free cash flow conversion, a whopping 102% for the quarter and 110% year to date.
Hold on. For those of us who don't speak fluent finance, what's free cash flow conversion and why is it so important here?
Sure. Basically, it measures how well a company turns its profits into actual cash.
Okay.
A high conversion rate like Rollins has means they're not just making profits on paper, they're bringing in the actual money. So that gives them tons of flexibility fund those growth projects, pay dividends, even buy back their own stock if they want.
So they've got the cash flow to back up their big plans,
Right.
but they are taking on debt too, right? How much are we talking, and is it a problem?
This is the surprising part. Their debt is actually super manageable. They've been really careful. Their debt to EBITDA leverage is way less than 1, both gross and net.
Wow, okay. Impressive. So they're not using debt recklessly to fuel their growth. That's
Sure,
good.
it's a fantastic sign. Especially for a company growing this fast. It gives them options, Flexibility is key in a market like pest control. It's constantly changing.
So their finances are solid, even with all this spending. But have they said anything about how they expect those financials to change in the next few quarters? Any guidance on that?
Well, remember, they're sticking to their yearly goals. Even with those hurricanes, they still want that 7% to 8% organic growth for the year.
Ambitious, for sure.
Very ambitious. But specifics on margins and profitability, they were a bit quieter on that.
Not surprising, I guess.
Yeah, it's still early in the game, lots of uncertainty out there.
Yeah.
But they keep talking up commercial pest control. Seems like that's where they see the biggest potential for growth and, expanding those margins long term.
So basically, trust us, the investments will pay off, our margins will get better. But investors want to see proof, like we said.
Absolutely. Rollins has a big vision, but they still got to prove they can deliver. We've talked a lot about Rollins' performance this quarter, their plans for growth, all that. But there's one thing investors always want to know.
What's that?
How risky is this whole thing? I mean, even with great cash flow, if a company piles on too much debt, it can really hold them back, especially when they're trying to grow fast at the same time. So where does Rollins stand on that?
Yeah, are we talking like a mountain of debt or a molehill? Give us the rundown.
Well, get this. Rollins might be the envy of a lot of companies when it comes to debt. They're in a really strong position.
Okay, now you got to explain that. What's their secret? How are they managing this so well while still spending so much on growth?
It really comes down to being disciplined. Their debt to EBITDA leverage is well below 1, and that's true on both the gross and net level.
Now, for our listeners who aren't finance experts, break that down for us. What's debt to EBITDA leverage, and why does it matter so much?
Sure. In simple terms, it's looking at how much debt a company has compared to its earnings. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. Basically, it shows you how profitable a company is from its core operations. So a low debt to EBITDA ratio, like Rollins has, means they're using debt very carefully. It gives them breathing room.
So they're not over-leveraged. That's a good thing, right?
It's a great thing, especially for a company that's in growth mode. It means they've got options. They can handle unexpected challenges, keep buying up other companies strategically, and still reward their shareholders.
It's like having a safety net, right? Take risks without blowing up the whole business.
Exactly. It shows they're generating consistent cash flow and they're managing their finances responsibly. They're focused on the long game, building something sustainable, not just chasing quick profits.
So bottom line, what's our take on Rollins Inc? I mean, we saw some potential warning signs like those margins getting squeezed by all the growth spending. So we also saw a lot of positives, strong cash flow, a solid balance sheet, and they have a clear vision for the future. It seems like they're doing a lot right.
Yeah, I agree. It's a mixed bag, but overall, I'm cautiously optimistic. Their dedication to long-term growth is impressive, and they have the resources and the smarts to pull it off. But like with any investment, there are risks. Can they actually make this strategy work? Can they keep raising prices as things change? Can they merge new acquisitions smoothly? That all plays into it.
So are we saying buy, sell, or hold? What should our listeners walk away with here?
Well, we never give specific investment advice on TalkTickers. We always tell our listeners, do your own research, make your own decisions. Rollins has a ton of potential, but it's not a sure thing. Investors need to weigh those risks and rewards and figure out if Rollins fits their own personal strategy.
What's the biggest question mark for you with Rollins right now? What should investors be keeping an eye on in the next few months?
For me, it all comes back to that commercial pest control market. Can they really shake things up and hit those growth numbers they're aiming for? It's a tough market, tons of competition, no guarantee they can stand out enough to justify all that spending. So yeah, I'll be watching to see if they can walk the walk.
That's a great point. Their success with commercial pest control seems to be the key to their whole plan. If they trip up there, it could affect everything else.
Absolutely. So even though their finances look great now, their future really depends on making this commercial strategy work.
Well, I think we've given our listeners a lot to think about. Rollins is a company with a really interesting story, And this earnings call gave us a good look at their plans, their hurdles, and their possibilities.
It's been fun breaking this all down with you, and I hope our listeners found it useful and informative.
Thanks for joining us on TalkTickers. We'll be back next time to dive into another earnings call. Until then, happy investing, everyone.